This illustration is going to talk about how to complete the cash flow statement for a particular sample farm. We're going to call it the Bounty Family Dairy Farm. Now this will show the different categories that you should understand already because you should have already listened to the introduction to cash flow before looking at this illustration. So if you haven't done that, please close this one and go back and listen to the intro and then come back to this particular video file. The cash flow is broken into three major categories. You have cash inflows to the business, cash outflows to the business, and then you have a section down here that's where you actually do a summary of the cash flows. And this is the area where you would determine whether or not the farm needs an operating loan, and if so, what would be the amount of the operating loan that would be needed to cover the business during the year. Notice in the cash flow, I did not use words like income and expenses. Uh, I want you to understand that the cash flow is all about money flows. It's not an income statement. It has no uh, attempt to identify profit. It's simply trying to identify money that's going to flow into the business and money that's going to flow out of the business. And anything that's a deposit into your checking account or a withdrawal from that checking account should be listed in a projected cash flow. Now, the cash flow is a projection. Don't forget, because again, your bank statement from last year would be a historical cash flow. Okay, let's look at cash inflows first. This segment right here is going to be money that's flowing into the business. So we're going to give that a little background color here. Cash receipts. This is a dairy farm, so they sell milk, they sell older livestock, and they sell some crops. These are all cash sales. What you want to do each month is sum them. Now to get that sum, you simply would hit the little auto sum button, make sure that it highlights what you want to sum, and just hit enter. And now we've got a sum of cash receipts. Sale of capital items. Well, what could go here is the sale of things like old pieces of machinery or a little bit of farmland, any of the capital type items, the non-current asset items on the balance sheet. If you sold one during the year, that's money into the checking account, so it should somehow be listed on the cash flow. So for example, if you were to sell, let's say $10,000 worth of old farm machinery for some reason in February. Now remember, we're projecting that sale. You would simply enter that number. All right. Now down here, this non-farm income, that would be like one, say you had a husband and wife farm, maybe one of the two work off the farm and earn a salary off the farm. So you could put that non-farm income in here. Now, of course, using this cash flow, if you want to keep it strictly the business and not an overall cash flow, you might not want to put that non-farm income in here. That would be a choice of the user. All right. Term loans. In this cash flow, we're going to assume that this farm bought $110,000 worth of uh, machinery or equipment or livestock or something, doesn't matter, but they're going to take out a term loan. In other words, they're going to finance that over 5-7 years. Well, let's say of that 110,000 that they borrowed 90,000 from the bank. Well, the bank's got to deposit that 90,000 into their checking account. That's a cash inflow. It's not income, but it is an inflow of dollars. So what we're doing is we're simply saying here in May, the bank's going to put $90,000 into our account because we think we're going to buy some new assets of some kind. Okay, down here for total cash flows, this number should be equal to the cash receipts plus anything that's entered into capital items, term loans, farm income. So again, I'll use the little auto sum and I'll click first on cash receipts and drag it all the way down just like this, and I'll hit enter. Okay, and of course when I take that across like this, okay, it's going to uh, it's going to sum. Now you'll notice that didn't sum anything up here because there's simply not a value. But when you pull that across here like this, you'll see that it sums the cash receipts and now it sums the capital items. So now one of the things you should do is complete this cash income section or cash inflow section, excuse me, for the Bounty Farm, because there will be some quiz questions over some of the values. Okay, now let's go look at money out. Well, one of the categories for money outflows is simply money you spent for operating expenses. Okay, so perhaps this item here should say farm cash operating expenses. There's no accrual adjustments because those are non-cash items, just like there's no accrual adjustments in the cash inflows because accrual adjustments are non-cash. So these items here simply represent the money that is spent for those categories. And over here, it simply estimates what month those are going to be spent when the money is going to be spent for each of those particular categories. Now, to get an operating expense total, you simply would come right here, hit the little auto sum button. Again, make sure it gets the ones you want and hit enter, and then you can copy that across and you'll get the total cash. And let me tell you what let's do. Let's go here and add the word cash so that we don't confuse anybody that these are cash expenses. Okay, the next category is capital purchases. Remember I said we were going to assume that we bought $110,000 worth of assets. Well, in the month that we project those, which is May, here we'll project 110,000. Now notice how this will affect the cash flow. We're going to spend 110,000. However, we're going to have borrowed 90,000 from the bank. So 90,000 was deposited into our checking account. But we wrote a check here, or we're going to write a check here for 110,000. So $30,000 has got to come from, or excuse me, $20,000 has got to come from some other source. All right, cash outflow, term debt payments, principal and interest payments on a loan. These are nothing more than amortized term loans. If this says you're going to pay principal of this amount every month and you're going to pay interest of this amount. If the farm had more than one term loan, these would simply be totals for those loans. If the farm had one loan on, say, a tractor that was monthly payments and then one on land that was quarterly payments, then you would simply add those numbers in the appropriate months. Okay? The next category of cash outflows is a projected amount of income tax and Social Security and Medicare. Okay? So these two numbers, those are too high. Let me fix those clicks. Get those in the right spot there. Okay? So we're projecting. Now this is an estimate of income taxes and an estimate of self-employment, Social Security, Medicare taxes. If the farm was going to pay those quarterly, then we would put those in 4 different slots for quarterly payments. Line 53 is family living withdrawals. And again, that's a choice of the operator. If you wanted to simply see if you need to take money out of the farm to live on, then this would be a place you could put that cash flow. If you were doing a cash flow strictly just for the farm and not for the family to pull any living at, you might leave this row 0. That would be entirely up to the manager. Okay, total cash outflows. So this number is a total of the cash operating expenses and all these other categories. So I'll use the little auto sum button and I'll go grab the total cash operating expenses and pull through all the other categories. And now I've got total money flowing out of the business. Okay, now you should complete those. You should do that for all of the cash outflows. You should complete for each of the months, and that will then give us a cash flow statement that has the total cash inflows by months projected and the projected total cash outflows by months. Okay. Now down here in the analysis section, what you want to do, this cash difference right here is simply equal to inflows minus outflows. So simply type equals, go click on total inflows and subtract total outflows. And that's the cash difference. So this cash flow is projecting a surplus of $21,108 for the month of January. And we're going to assume that there's 0 beginning cash balance. Now, that you could say that the farm started with a cash balance, but just to keep this to illustrate, we're going to assume there's no beginning cash balance. Cash position is simply defined as the cash difference for the month plus the beginning cash balance. Okay? Now, this cash position at the end of the month is simply the beginning cash balance at the next month. So for example, when we go to February, what we're going to do is we're going to say equal the cash position here, and that so then when you get a cash difference, then you'll add this uh, beginning cash balance, which was the ending cash balance of the previous month, and then you'll get a running total. So when you complete this table all the way through, it'll simply show you how much cash should be available to the farm at the end of each of the months. Okay? You're, I'm not going to discuss anything beyond this at the moment because in the next illustration we're going to have some deficits in this cash. So what that means is we'll have to borrow some money. But in this one, I think you'll find that these numbers will stay positive all the way through the calendar year, so you won't run into a situation where you'll have some deficits, but it won't use up all of your money. So complete the Bounty Dairy, get the numbers, and have those ready when you take the first of the cash flow quizzes, because it will ask you questions. Plus, it'll ask you questions over the next illustration where there'll have to be some money borrowed.